A secured loan is a borrowing agreement where you pledge an asset as protection for the lender. Let us break down how this works. The key term here is collateral. This is the item of value you offer the bank, like a car or a home. Because the loan is backed by your property, it is often viewed as lower risk for the bank compared to unsecured debt. Secured loans typically come with lower interest rates, but the trade-off is the risk of losing your pledged asset if payments stop. Unlike credit cards or personal loans, which are unsecured, secured loans require you to lock up an asset until the debt is paid. Because lenders have the security of your asset, they often offer more competitive interest rates than they do for unsecured personal loans. The most important takeaway is to ensure you have a solid plan for repayment before pledging high-value assets like your home. Understanding secured debt helps you make better choices for your financial future. Please subscribe for more simple finance explanations.